Tom Basso has always been kind of a hero for me in the sense that he really was the first guy that I saw that had that mentality where it was you can be a good trader and also have a life and not be miserable all the time trying to outthink every single situation. And you will probably make more money not trying to do that. And he's the first guy that seemed to have that balance that I wanted, that I didn't really understand how to get until I started really listening to him talk. And then also the constant, how many things he has out there on the internet, the interviews, how kind he was to give us so much time just talking to us. So, getting to sometimes getting to meet people you really look up to is a losing battle. But with Tom, it was nothing but a treat, and I learned so much. Um, just editing this and going through it has been really amazing. Just to listen to him speak all over again. There's a lot of times in the interview that I'm just kind of sitting there, kind of dumbfounded, just because I'm really trying to soak everything in. So I hope everybody else gets that from this as well. I think it was one of the most enlightening interviews I've been a part of so far in this series. So I hope everybody enjoys it. But yeah, so basically, I've always looked at you as a very inspiring trader to me because I was the guy who was running around like crazy at the beginning of my learning how to trade. Just I looked at the markets all day long. I was driving myself crazy. I was obsessed with learning it, but at the same time, I was just obsessed, and that wasn't the way to be. And then I hear about, I read Market Wizards and I hear about this guy who's, basically has a good life, like
Supposed to
that's,
be Mr. Serenity,
yeah,
whatever that is.
and I'm like, that's not what trading is. At the beginning, you think trading is this thing that you're in it all day long and you're going driving yourself crazy. And so it was very inspiring for me. My background, I was an addict. I'm sober about 12 years now.
Oh,
Um,
congratulations.
Thank you.
Good for you.
And so, my normal personality goes to the obsession part, a
Yeah,
lot.
sure.
And
Yeah.
and that was another thing that happened to trading. My girlfriend always jokes with me about how I had to go to AA for traders. Um,
Yeah, I have a number of traders and actually a number of brokers, number of addicts that were on, literally cocaine or whatever. And
yeah,
a lot of them, when they get rid of the addiction to, say, cocaine, they become addicted to exercise, or they become addicted to watching movies, or to doing trading or whatever. They just substitute one addiction for another. It's a lot of that to me is comes into the self-awareness part of it.
yes,
If you I had the good fortune somewhere, starting in high school and then beyond, where I had this observer self sort of helping me. It was like a part of my brain was keeping track of what I was doing all the time and comparing it to whatever ideal I wanted to get to, and to kind of remind me when I'm going off on a tangent. And I think if you remind yourself that you're going off on the tangent, then you can self-correct back to, in a disciplined fashion, to whatever it is that you want to live your life as, or trade or exercise.
yes.
Rather than run a marathon, maybe you just do a 5K and you stay in good shape. Maybe the marathon for a 68-year-old guy might not be a good choice.
Yeah.
That type of thing. So I found that was quite a blessing, because it allowed me to be more disciplined with my trading, create the plans, stay on the plans, do the same thing with my exercise, same thing with my weight, try to hold my weight. I'm still a 36 belt size that I was when I got out of college.
Nice.
And, it's not that difficult when you get to it, when you finally understand what's going on in your brain and all that. But I think a lot of addicts, whether it be trading, drugs, or weight loss, I mean, people that are having a hard time keeping their weight in check, I just don't think when they see the chocolate cake, they love chocolate, and they're eating it already.
Yes.
If you have an observer self and you have a little discipline, you say, chocolate cake, I've been running a couple pounds high. I think I'll just, eat one spoonful of it to be gracious and then leave the rest, or something, you know what I mean?
Yeah.
There's that corrective mechanism. And I think the same as in trading. People get obsessed with the excitement and the thrill of the hunt and the thrill of victory and the agony of defeat, as they used to say on, was it ESPN or
Yeah.
whatever, a long time ago, probably before you were born, actually. Oh,
Maybe,
it
maybe.
was Wide World of Sports, I think it was, or something, whatever.
Oh,
Yeah,
I did have seen NBC. It was NBC,
yeah,
Wide World Sports. I have
yeah.
seen
There you
that.
go.
So,
Yeah.
but yeah,
But
no,
I
that's a
think
good
what
point.
the action is where everybody gets, the excitement. And I just finished cranking up late in the day. I finished up some of my ETF orders, and I'll just have to run my futures orders. But everything takes maybe 30 minutes, and it's pretty tedious, really. It's not exciting at all.
Yeah.
And I had a down day today, but I had an up day yesterday. It's like the same thing, same time. Not much happening. It's not much exciting. And after we're done with our little interview, I'm gonna head out and play golf with some friends for 9 holes, and then they're coming over for dinner. So that's a typical day for me. I don't spend a huge amount of time watching the markets. If I'm going
Yeah.
to be, in the office all day and don't have errands to run all over the place or landscaping or something else to do, I might day trade, in which case then I do have to, watch the couple things that I actually do. But even that is all systematized. It's pretty boring, really.
And that's honestly the best way to be.
Yeah.
It can just be that. That was one thing that I found was interesting. I read your interview, and there was another guy who was a trend trader. What was it? Bill Dreiss.
Okay.
And he had his first thing, he was a surfer. So I grew up riding BMX bikes. I did that for a long time. And he was a surfer. And I was like, this guy's a surfer and he's a systematic trend following trader. What, how does that work? And so it kind of piqued my interest. And then also I said it the other day, which was, it was kind of a survival tactic to find trend following because, in anybody can think, it's easy to think and overthink and do something stupid, but really understanding your time frames, how long you're going to do something, to hold on to those trades, understanding how you're going to do that through back testing and so on. Like that's a huge edge, whether you trade systematic or not. You
Yeah.
just have to have that. So I thought that was really awesome that you guys, were doing that. And that kind of
Yeah.
helped me in my journey a lot.
Yeah. Yeah. I find back testing, a lot of people misuse it. They sort of get the number and they lock their brain onto 20% per year. And that means
Yeah.
1.5% a month or whatever. And then when it doesn't really come out so easily, and you might even go into a drawdown right as you start up the program, and then you're not really well mentally positioned, and you don't trust it, and then you start changing the system, or you start abandoning it and finding another system. And I really find systems simulation is much more useful in helping prepare you mentally. But to do it, you have to do the hard work, which is to take the simulation, break it down into weeks, days, months, sit there and tediously go through and look at the charts and look at the profits and losses that are coming in every day, and imagine that this is what you'd be seeing on your screen, and almost kind of try to scare yourself a little bit into understanding what you're going to be going through, and you're kind of mentally preparing then. And then when you actually run it, it's kind of, unless something unusual happens, then everything you're looking at is exactly what you expected. So there's no big deal. It's
Yeah.
kind of,
And
it's
that's
just,
that's what a lot of people have a lot of trouble with. And you talk about the observer self, all of these things, and I think it's part of trading too, to really be able to see, like, there's always going to be the risk trade. I will go into every trade thinking I'm going to lose money usually,
yeah,
just to be ready for it.
that's
And then
good.
also, then
Yeah,
on the other end of it, I also need to, and I think you might agree with me on this, I need to see in my head that that could also go the other way. also be ready for it to move in some crazy direction. Something, just for simple example, lumber futures, that being such a crazy move, you could have
I
never
was in
predicted
on
that in a
that,
million
and
years. Yeah.
yeah, I'm looking at it. I'm going to say, wow, we're having a great day today. What the heck? So I go over to, I pull up the screen and I look, and lumber's up limit.
Yeah.
Oh, what? And this was, I mean, a long time ago.
Mm.
And then it was up limit again, and then up limit again, and up limit again.
Yes.
And I'm just sitting there every day going, wow, this is pretty insane. And I'm, my risk adjusting controls on my position size get me down to one contract eventually, because the volatility is off the charts. The risk is going nuts because I
And they grew so much.
can't move my stops up fast as the market's moving. So I'm getting bigger and bigger risk per contract. So I'm peeling off contracts to get down to the one that I had at the end, but rode that all the way to the finish. And then son of a gun, I get a nice setup and go short, and then it's like limit down, limit down, limit down, limit down. And
Yes.
good grief, I mean, the last month or two of lumber has been insane.
Yes, and that's the really interesting part, is that as a trend following trader, like, you can really be in those moves, without sitting there trying to predict everything. Because if you're to me, I catch a lot of people always ask me about catching moves. Like, I caught natural gas, I caught all these things, but like I do, it's not magic. I'm also catching a lot of no moves. A lot. I'm catching a lot of stops in certain things. So it's but you once again, you make your losses small, you make your winners
Yeah,
big, you will do very well. And this market is very favorable to our style of trading.
yeah,
Where it hasn't been for a few years. Right now, it's like, okay, this is literally the type of market that's just perfect for trend
yeah.
traders, basically. So
Yesterday I was at all-time equity highs.
yeah, yeah.
Today I pulled back from that a little bit, but it's been a wonderful period. Volatility feeds trends. When I did the study that's on my website on what feeds CTA profits, it was clear to me that all the big guys were so tied up with trend following because of the nature, and it was long-term trend following, really, probably. So that when I saw big moves in the general large liquid markets, the top 20, let's say, I could take that, and when I saw big volatility, I saw bigger CTA profits. When I saw smaller volatility, I saw smaller or CTA profits or losses. So when you looked at the Barclay types index back in the old days, the MAR index, those categories, when you looked at CTAs and systematic CTAs, they were clearly trend following, because the more volatility there was, the more trends go a long way, the more profits that you can make. And simple as that. It's not brain, it's not rocket science. It's
Yes.
pretty common sense, really.
Another thing you talked about, which I had to ask you more about, which is so when you were talking about your lumber position and
Mhm.
going to smaller, less contracts. I know a lot of people are always very split on that, and I go over it all the time in my head. What should I be paring down positions? Should I build? Like, I don't add. I usually stay the same in positions unless it's extreme. But I wonder, you have a lot more experience with this and probably have tested it a bunch too.
Yeah, I have tested it actually. The test would say that the best return to risk day in the entire life of a trade, because I took all the trades we did for years across like 20 different markets at Trendstat days. And I took day zero was the initial day that you got into the trade on a trend following buy, let's say. The next day, because I had the perfect hindsight of knowing when this trade finished up, I could take the return that I eventually made on the trade against the risk to the stop loss point and measure the return to risk. Day zero, I could then go to day one, measure a new return to risk. Stop is moving. The endpoint doesn't change, but you're closer to the endpoint. So maybe your return is not quite as good to wherever you're going to get out ultimately. You don't know where that is in real time, but with a historical database doing simulations, you could actually know where that end date is. So I kept calculating return to risk every day, day 1, 2, 3, 4, 5, all the way to could be day 45 or 62, whatever it is. Then I databased all of those subsequent days, averaged them, and it's very clear to me that the best return to risk ratio is the second moment of when you got that buy or sell stop to get into the position initially. However, that being said, uh, your drawdown when you're a CTA, I learned this painfully. The clients are going to look at their statement every day and mark to market everything you do. So
Yeah.
if you touch $2 million under management in the account exactly, and the next day nothing changes, you're in the same positions, no big deal to you as a trader, but to the client, you're at 1,998,000 and you just drew down $2,000 or whatever, and you're on a drawdown now, as
Yeah.
far as they're concerned. And so I started realizing that, and I started thinking about what ways can I affect my return to risk ratios. And one of the things that I came to, along with the fact that that famous silver trade I did that Jack put in the book way back in, I don't know, it was the 80s or something, where I had a number of contracts and I just did like you. I had the signal, I got multiple contracts. Damn it, I'm going to ride it all the way to the end till I get a sell signal. And I was every hour checking with my broker. Back in those days, it didn't have all the electronics that we have now. So I'm calling the broker and bugging him, and I really basically have a portfolio of silver and a few other things. The other things didn't count. It was just whatever silver was doing that day drove the portfolio. And I realized that that's not a diversified portfolio. That's not sensible. Why should silver be dominating just because it's moving faster? I should probably be adjusting my positions and my risk of the silver position to keep it in line with everything else. Then I would continue to have a diversified portfolio instead of silver and a few other things. So that led me to the ongoing volatility controls, ongoing risk controls that helped Trendstat be what Trendstat was, I guess, over the years, because we were able to start with good return to risk positions right on the initial signal. And that from that point on, we gave it room to move. Like if you, for example, if you had, say, a 1% of equity risk level and you set your position sizes on that, and based on the size of the account and what market you're trading, maybe you got 10 contracts. Well, then the market would move in your favor, and I'd give it up to somewhere around 2.5 risk as a percent of equity. So I'd give it some room to move so I could make a profit.
Yeah.
Well, once I'm into the profit, maybe my stop loss isn't moving up as fast as like lumber, or is going crazy. I can't get my stops up as fast, so risk is increasing. So then you say, well, instead of 10 contracts, I only need 9 now, or I only need 8 now, or then I need 7. And pretty soon you're not really taking profits in my mind. You're just managing the risk and volatility of that position. It's a different mentality. A lot of people always accuse me of peeling off my positions to take a profit. That couldn't be farther from the truth. I'm not at all doing that.
No,
I'm
I didn't think that at all.
I'm taking them off as at market the next morning, just simply to get my risk and volatility back in line. And as long as there's more alarms coming in where I'm going over my 2.5%, let's say, or 2.3%, with some
Mhm.
number higher than one. And on the volatility side, I tend to do like 0.7% volatility and zero point 0.9 to start taking them off. But those are not magical numbers. You can make them whatever you want that makes it comfortable for you.
Mhm.
And but the bottom line is you'll get these sort of alarms coming in, and positions get peeled off individually. And then I even have a portfolio risk level that I set, I think around 17% these days. I think we used to run around there, 16, 17 at Trendstat. And so if the total portfolio risk altogether gets up to that level, I start peeling off a slice of the whole portfolio just to get it back into where it needs to be and where my comfort level is, and
Mhm.
where where I think you're going to help reduce your drawdowns, because as you're hitting, if your whole portfolio is getting risk levels of 17 and 18, 19, 20%,
Mm,
you've probably had some good runs in a lot of different markets, and you're probably hitting all-time equity highs on your run. And
yeah.
remember that as soon as you hit that all-time equity high and go the other way, that's where your next drawdown starts.
Hmm.
So anything you can do to sort of lighten the load and keep your risk in control is helping to cut down that next drawdown that's going to happen.
That makes a lot of sense. It's
Right.
very well said. The one thing I would add, when you were trading that silver trade. Now, I
Hmm.
actually just listened to the story the other day to think about to talk before the interview. But it sounded like, and I didn't, you didn't dig into it much, but it sounded like you were still at that point of maybe the position was too big to start out with. Was that the case, or
I
was
don't
it?
know how my account had gotten, like I'd gone from trading a few $1,000s and then over just putting more money into it, getting
Mm,
better at trading, whatever, about 4 years to actually break even in 1 year. And then my fifth year, I finally started making money trading.
mm,
I had gotten the account up somehow to 130,000, I remember, somewhere around there. And, at the peak, it got to 500,000. And this is all within, I don't know, 6 weeks or two months. I don't, it was a
it's a
very
monster.
crazy period for me. So now I go at 500,000 and I'm going nuts watching this thing because it's changing my life basically. It's paying for my house. It's starting up, the money management firm that we started up with a couple of other guys way back when. So yeah, this is pretty life changing, and I'm starting to get stressed out over it. And I realize that I'm getting stressed out, but I kind of have good reason to get stressed out. And
Yeah.
it goes all the way back when they crushed the hunts and had it fall apart. Then it was limit down, limit down, limit down against me. And I finally got out at about $250,000 account. So from the outside observer, I started at 130 and I end up at 250. That's a nice couple months of trading, right? But for me, it was like, holy crap, that was that was a wild ride. We
Yes.
need to you need to think about that a bit. So I spent a lot of time thinking, and it just became obvious to me that I can still be a trend follower or a systems trader and be disciplined and get my buy and sell signal right, but I can be just as disciplined in managing my risk and volatility in the portfolio. So I developed, based on reading Larry Height's chapter in Market Wizards.
Mm,
He talked about making the bet sizes the same all the time, and that one trade coming up is no different than the last trade that you did. And that started making me think about how is he mathematically doing that. And I saw some kind of a percent risk as a percent of equity, volatility as a percent of equity. I
mm,
added later on margin as a percent of equity, and I limited my position sizes initially and ongoing to certain percentages of equity that I felt were comfortable to my clients or to myself. Uh, Certainly myself now that I don't have clients.
mm.
And so it mellowed out the ride a lot. And that probably single-handedly helped me to become Mr. Serenity in Jack Schwager's mind, because it just mellowed everything. No one market was ever dominating. I didn't have to, there'd be a day where, yeah, lumber goes kind of kablooey and you look at it and say, wow, but it's really not driving my portfolio. It was contributing nicely to the portfolio every day when it was doing limit stuff, but it
Yeah.
but my returns were not just lumber. There was lots of other stuff going on at the same time. So I could make a lot more than just the lumber profit, or I could be making a lot of money in lumber and losing some other things and having a break even day. But it wasn't day after day after day of lumber dominating my portfolio like it was back in those silver days.
Yeah.
So I think I've achieved the smoothness that I enjoy having in my portfolio. And I understand what every strategy is doing and what it's contributing during sideways periods, during trending periods. I do trade some non-trend following stuff at least in a lot of people's minds. What I do is I go so short term that it almost looks like I'm trading in the range.
Mhm.
All I'm doing is doing trend following on a very, very short term basis so that it gives me lower risk levels per trade. The risk to the stop is a lot tighter because of the short term nature of the indicators. And then the ability to, reverse and go different directions. This morning I noticed that all my grain positions went from short to long,
Yeah.
whatever, that's fine. That happens. Crude just a couple days ago went from, I think I ended up short for a little bit there and then now back on the long side. So it's the nature of trading. I'm
Yes.
agnostic as to which direction makes the most sense in any market. I don't waste time even thinking about it hardly. And you just you go with the flow. Keep your position sizes set beautifully, and then just go out and play golf.
Yep.
Do something different.
That was so well said. And that's so interesting. And the one thing I see a lot is I have a group which I have traders in the group. And what they have so much trouble with is I'll talk to them and be like, all right, well, I'll help you. Send me what your position sizing is. They'll be, for example, let's say like, if you have $1 million account and then you have somebody with $100,000 account and they'll be more leveraged than I am, and then I'm like, what are you doing here? Like that's gonna
Well,
and now I'm starting to see why they're messaging me in the middle of the day when something goes against them. Like because to me it's nothing. So I get stopped out so many times.
yeah,
It means nothing to me. But when it's half of your portfolio, sure, I get it.
yeah,
And
catches
it's
your attention, doesn't it?
yes, and that's so important because like you said, like you not only like you get to put on those trades and they make these huge moves and you're like happy because they make these huge moves, but also when you're smaller you're going to be able to trade those well. You can't trade well when you're stressed out and you're driving yourself crazy all the time. And
Yeah,
that's one of the most important things you said in that is that I deal with so many people and that's the biggest problem they have. And also they think that you can't make money if you're not trading huge, and that's such a lie too. You have to have I'll let you answer this in a second, but I'm sure you have to of course have some form of size. It's like you said, lumber is going to add to your portfolio nicely, but it's not going to kill you if it goes against you. And that's a
right,
good balance that you have to figure out.
exactly. And the other one of the tricks that people forget about with trading is, especially those that are trading more frequently, you can afford to you don't have to leverage yourself as much as you think you do to end up at the end of the year with a very high compounded return. And the reason I say that is if you do a good job, I'm trading, if I'm not day trading, I'm trading 7 different strategies. If I'm day trading that day, I've got 8 strategies,
Mhm.
right? Because I got one that I run while I'm over here doing work and researching or writing letters or whatever I'm doing. And over here on my other screen, I've got the market open to my indexes that I trade and so on. So if you can keep your drawdowns low and keep clicking out profits so that you don't have to, so you spend a lot of time making equity highs, that starts compounding because as the dollars go up, your position sizes start getting greater. So if you're successful and you keep those drawdowns to a minimal, then when you get down to the end of the year, you're trading a lot more. Your position sizes are more, they're going faster. If you look back to that original equity, you're picking up large amounts of return towards the end of that year that you wouldn't have made on that original equity size.
Yes.
And so shooting for the big hits on any one trade is a very wild ride, and you're going to have the big ups, the big downs. The return to risk gets awkward. If you can plod along but do it in a very consistent fashion by either multiple markets, multiple strategies, some that are more mean reversion, some that are more trend following. Maybe you're trading ETFs over, in one thing, and you're trading like sector ETFs. I trade,
Mm.
and I have a certain strategy with that. And I have a shorter term strategy where I trade high momentum ETFs. I have another strategy that is just for hedging the long positions. So that's the one on my website that everybody always goes looks at.
Yeah.
And then I've got a short-term stock index trading strategy that I trade Nasdaqs on. Uh, I've got an option strategy where I sell spreads or put spreads or call spreads based on whether it's overbought or oversold. So a strategy like that on a day like today where it's going up and I'm overbought, so I sold the last few days a couple bear spreads.
Mm,
So calls designed to make money as it goes down, they lost today because the market went up. So that strategy wouldn't do well when you have a highly trending market. But the short term index strategy that where I'm long Nasdaq futures, that does it okay on an up day. Uh, the hedging program doesn't do anything because the market's up and it's just designed to do a short sell when I
yes.
get a hedging trade. So all these things kind of come together to synergistically keep the account smooth. And they're all sort of fighting each other, but each one has its own positive edge. And I think if you can do that, you can compound without taking a lot of risk. You can compound up nicely for the year. In retirement, geez, I'd be happy with 10%. I'm not looking
Mhm.
to be a big hero, but I mean, last year I was up 100%.
Yeah.
It was that kind of year. I didn't force it. I didn't take any more risks than I'm taking today,
Mm.
but the markets were very favorable for trend following, so I exploited it.
I love what you said there because that's it's something I talk about a lot, and I shared this the other day. I made a video and basically kind of went over
Mhm.
all the different strategies I use,
Yeah,
and I also keep track of how they're working. If one's working above another, and so on, but that doesn't mean I start to stop taking signals. I still take the signals. So it's very cool that you said that because that's something that I think for myself, I think that's so important to my trading. I think it's, markets change so much. And if you have a bunch of really good strategies, like let's just say three even, you have three
yeah.
good strategies that you know well and that you can just execute over and over again, that adds to your chances of making really good returns. So, great.
Two. Have
Yeah.
one that's a trend following and one that's a noise pattern,
Yep.
picking up profits during sideways markets. The stock market in the historically, I want to say it was like the study I did was 29% up markets and something like 7 or 6% or something down markets
Mhm.
using the indicators that I assumed, a little moving average, stupid stuff. And the rest of the time, like 67% or thereabouts, was in sideways markets. Markets, if you did a buy signal, it didn't follow through. If you did a sell signal, it didn't follow through. It was just sideways.
Yeah.
So if you're trend following during those periods, you're going to get whipped, sawed. But um, if you got a sideways, like the spread hedging or the spread selling the spreads that I'm doing, or
Mm.
my short-term trading strategy that's so short-term it exploits the moves in very short periods of time, so it's much more going to have a shot at making money during a sideways. Then you can be making money during the sideways, you can be making money during the trend following, you're balancing them out, and that's just running two strategies. I've heard a guy named Lawrence Bensdorp, who's a friend of mine, partners with me on some of the seminars we do, and you know the he has a great term. He says if you look at a track record and you see those drawdowns, what you need to think about strategy wise is how to fill those holes. And it's such a great analogy to filling a hole because what you're trying to do is to say, why did your strategies really suffer during this period? And is there a strategy that you could create that would have a field day during that period? And what you're going to be doing then is kind of taking that drawdown hole and sort of filling it up and pushing it back towards the nice smooth line that everybody would love to have. And you never get it to a perfect smooth line, but you can
Yeah.
certainly fill the hole quite a lot and make your life a lot easier in the process.
That's interesting, and for me, dealing with clients now and client money, that changes things because it's there. You as a trader, you understand that you're going to have these whipsaws and all these things, and there can be catastrophic. I have a similar to the way you talked about your stop. I have a catastrophic stop as well. I know that all of these things can happen. But then when you add clients into the mix, you have to trade differently because they don't handle it the same way you can, and that's
Yeah.
something that you either have to be very selective about who you're picking, or if you want to not do that, you have to really understand that that's how normal people will react.
Yeah, I've trade differently now than I used to for clients. I have much higher risk tolerance and much more knowledge of what I'm doing, and my average client did not have that. So rather than put my average client through the ringer emotionally, I had to sort of ratchet myself back, which is another reason probably why Mr. Serenity nickname got put on me by Jack. Is he looked at my returns, and compared to some of the other traders he went and interviewed who were more the uh, atypical or typical trader stereotype, I guess you could say,
Yeah.
the stress and the chain smoking and
Yeah.
knock off of work and go polish off a bottle of bourbon or something to relax and try to get to sleep. That type of mentality is far away from me as it could possibly be. So I think he felt like I was so boring, nobody would be very interested in the chapter. But as it turned out, he was much amazed that not only was he attracted to the way I traded, but a whole lot of other people have been too. And now I got a website, Enjoytheride.world, in retirement, and just helping traders and doing podcasts from time to time, which kind of keeps me in touch with a lot of the trading world. And
Yeah.
I like it. It kind of keeps me young and keeps me challenged. I mean, when I love it when people ask me a tough question that I haven't had asked of me before, and I have to actually think of the answer,
Yeah.
and that's always fun.
That's awesome. And yeah, and also just to add, like you have a ton of really good videos online. I think that's the one thing that a lot of people, even though market wizards, there's so much in there. There's so
Yeah,
much in there. But
yeah.
as a new trader, you kind of think like these guys aren't giving me the secrets, But really they are. But a lot of people think that. But for you, if you go through, if somebody's watching this and they go through and they look you up, like you have a bunch of really cool
Well,
seminars. You show your back test on
I've got three
Trendspider.
webinars that we've done, and I got recordings put up on the Enjoy the Ride store.
Yeah.
That for like $29, you can watch an entire hour on all sorts of interesting topics that we've done. And then I
Yes.
probably will do some more in the future. I kind of do them when I am in the mood to do it. I this is not a I'm not looking to make it $1 billion business or anything.
Yeah,
Uh,
but it's
but
super
the
cool.
website pays for itself, so I don't have to dig into my pocket. And yet, I got a whole bunch of advice of almost every interview and podcast that I've ever done that I can get a copy of.
Mhm.
I throw it on the website under the interview tab, so you can listen for free to I don't know how many hours at this point. I've never added it up, but it's got to be
Oh, there's a
15,
lot on
20.
there.
God, there's got to be 25, 30 hours. And Michael Covell alone's got, I think, a 4 hour Super Basso episode, he calls it.
Yes.
I've got all these other people that have interviewed me. All I usually ask is, hey, when we're done with this and you get it all polished up and are ready for your podcast or your website, send me a copy and I'll put it on and I'll link mine to yours and everybody will be happy. And
Yeah,
people
for sure.
come to there, and I get all sorts of people then contacting me on Twitter or Facebook or wherever and say, I've listened to all of your interviews, and I have the one question that whatever is bothering me. I can't figure out what to do with it. And that's
Mhm.
great. That's why I put them there, and it saves me a lot of time because I was getting 6, 7, 8 emails a day. I mean, I literally answered thousands of emails, answered every one of them,
Wow.
and there were some days. The thing that really hit me one day where I had two different people in two different countries ask me precisely the same question, and I sat there answering it the same way I did in the previous one. And I thought, God, this is highly inefficient. I'm sitting here typing answers. I'm just repeating it. I should at least cut and paste or something, copy and
Yeah.
paste, and make my day a little easier. And that's when we came up with the website idea. I said, hey, I want to put all the answers that I can come up with to a lot of people's questions and videos on how to trade and recommendations on books. They say, what books do you recommend? Well,
Mhm.
go to the recommended reading tab, and they're in order the way I'd recommend them. And it saves me a ton of time. So the website's been really, really good in terms of saving me time. And in the process, it's an easy way to, mass produce information. I can update the hedging chart, and all of a sudden, thousands of people can just 24/7 go and look at the hedging chart and see what they want to see out of it, learn how to maybe set up a strategy. So it's been good. I've enjoyed it.
Nice. Yeah, I absolutely love it. And you talking about so much information. Yeah, I have digested a lot, a lot of the information on there, but it's
Yeah.
really, really beneficial, and it's
Yeah.
really helpful because I think a lot of people, when I talk about my strategies, I think people in general automatically, if you don't really dig in, you think they're so intricate, they're so they're just so crazy that nobody could do them. But really, most of the time, strategies can be very simple, and anybody's strategy can be extremely simple and effective. It's just, and that's another question for you, which is
Yeah.
why do you think it's so hard for, even though you could, like we were just talking about, strategies can be very easy, easy to put on, easy to
Yeah.
take off, but why do you think so many people struggle with the ability to just follow that plan and that system?
Well, I I can give you an example. I won't say the name or anything, but a gentleman that I just got done writing a response to a question that he had. He told me of his life. He's become disabled. He wanted to learn how to trade to try to, because that's something he could do even being disabled. So he had to take an early retirement basically, and off he went. And he hasn't been successful yet. And so I said, okay, well, you have an assignment then. You're going to write back to me, and you're going to tell me your entire process from the time you wake up to the time you go to bed, anything that has to do with trading, how you approach it, and all that. This book that he wrote me was unbelievable. He starts with the Wall Street Journal, then he reads this, and then he
Oh,
reads
wow.
that. And by the time the market's open, he is so 50 different directions in the first place. Then he gets up there and he waits for this. And if the market's pulling back to the moving average, then I can get in here. Oh my God, there's no sensible, this is what I do every day. There's all sorts of judgment. He's trying to predict which way the markets go. I don't predict anything.
Yes.
And so I kind of let him have it, and say, I told you, you're trying to develop a strategy. This is not a strategy. This is a conglomeration of a lot of reading and a lot of listening to these people and taking seminars and reading books, and you're just confusing yourself. You've got so many different ways, or you're being pulled. You have no idea what your strategy is in the end. You're just making it up on the fly, and that's why you're not successful. So
Yes.
I gave him some simple things to think about, and tried to give him a little procedure with some questions and potential examples for those, as answers to those questions, to give him some idea of how you would develop a trading strategy systematically. Just what's the answer to this question? What are you going to use for this? How are you going to size your positions? How many different positions are you going to have in the portfolio? Blah, 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 blah. And just go down the list. And when you get all done with that, just run it. And if you
Yes.
don't have a trade come up, sit on your hands and do nothing. Go find something else. Go play with your kids. Go read a book. And I'm not talking about a trading book. Go read some fiction novel or whatever, just that you might enjoy. Get yourself out of trading. I think
Yes.
so many people. He's very obsessed. He's addicted to trading.
Hmm.
I can tell that. And I think that's why a lot of people can't be successful. Is they think that, okay, yeah, Tom's a chemical engineer by degree, and he's got a master's, and he did 28 years in the money management business, and he's this really brilliant guy with all sorts of experience, and he knows math, and so he can trade, he can automate it, and he can, do 7 strategies, and they're all complex and all that. They're all simple. They're all things that in some cases I might have gotten the idea from something I read or hearing, a conversation with some person asking me questions triggers my brain to say, I could probably do something to fill the hole in my drawdown here. This would be useful. Maybe I can develop something. So I just think it through, keep it simple, write it up. Usually I'll go on a Word file and I'll just start writing, and I'll put down the objective of the strategy, and I'll put down, and the objective is not to make 5% a year or something. The
Yes.
objective is, what type of market structure does this strategy want to try to exploit, and what types of market structures and periods are going to give this type of a strategy a rough time. I want to try to build that together so that I can fill that hole. I've got to be able to make the money when the money's got to be made. And then the rest of the time it's stay out of trouble.
Yes.
And so I think a lot of people, gosh, I had a partner once, and I think I've given this example a couple times, but we were doing mutual fund timing back in the day. And he got to sort of writing everything down. So he had his rules. And I came back from being out of town on a marketing trip, and I said, "Hey, are we long on the mutual funds?" And he says, "No, we didn't get a signal." And I said, "Huh, that's funny. I thought we'd be long by now." And so he starts saying, no, he pulls the book down. He starts flipping through. He says, well, first you look for the indicator to be this, and, and then, okay. And yeah, that's fine. And then you decide whether or not this is the case. And then he had added and added and added. And he had filters, and he had multiple indicators, and he had made it so complicated. And then he flipped the last one, and he said, and then you look for this. And I said, okay, well then everything you just told me says that we should be long the mutual funds right now. And he looked at me and he goes, holy crap, I missed the signal. It was so
Yes.
complicated, he didn't even know what he was doing anymore. And that is why people can't be successful. They love making it complicated. It sounds like it's going to be better. But
Yes.
Jack Schwager had a great term for that. He said, there's in statistical terms, degrees of freedom. He called it degrees of restriction,
Yes.
because what you do with a trading strategy, when you start adding filter upon filter and indicator upon indicator and parameter upon parameter, you make fighting history wonderful. I mean, you'll have a great track record with minimal drawdowns, your return to risks look great and everything. But what you did by doing that is you fought the last battle, not the next one. And
Yes.
the next one's going to require a different set of indicators, different set of parameters. And to be robust, if you just keep those parameter sets and those indicators simple and easy, they're going to be able to react to more different conditions, maybe not perfectly optimally, but they're going to get there, and they're going to get you that lion's share of the profits that you can pull out of that market. But if you make it so restrictive that you can't even get on the trade, and you're sitting there twiddling your thumbs watching the lumber go up and down, and you didn't get a lumber trade because you had 5 different filters on it and it just didn't meet your criteria, then that lumber trade isn't going to be there in your portfolio. You're not going to make money off of it. So
That's a good
keeping it
point.
simple with small parameters is the best way to go.
It's a great point, and especially I talked to there's actually a trader in the group. He's a futures trend follower as well, and we talk a lot. He uses
Yeah.
a 200-day moving average, and I continue to tell him like it sounds cool, but sometimes you're going to get these signals that are you're going to filter yourself out of good trades, and we
Yep.
talk about this a lot, and it happens a lot. And not to mention, the simple fact of if you're in a trade, and let's say it's under the 200-day moving average, and you get this signal, and then it turns back around. Oh no, you got to stop, and it's 1% of your portfolio.
Yep.
It's just not anything to really worry about. So that's
Right.
well said. Well said.
Yeah.
There's it gets to be too much, and you're right. People make everything more complicated than it ever could need to be.
People can't figure out how the heck I trade 7 strategies and I'm almost never in my office. I'm out. Yesterday I did 2 hours of landscaping. We're setting up for a 4th of July party and I wanted to pretty the yard up. I do all my own landscaping.
Yeah.
So, I mean, I went out and played golf for 9 holes yesterday afternoon. I'm going to play another 9 this afternoon. Um, and
Nice.
people are, tell me about their days. They get up at god awful hours and they're getting, prepared to trade and it's like getting their coffee down and making sure they got a buzz going. And geez, I get a
sounds
life.
yeah, sounds absolutely miserable. But also that there's a guy that he runs some service, and I talk to him from time to time. And he used to be a football player. I used to be a professional BMX rider.
Yep.
And we were talking about just athletics, and he was like, you know what, I realized, I'm either 320 pounds and stuck in my chair and killing it at trading, or I'm 250 pounds and not doing well at trading. I'm like, that's a huge trade. You're talking about your health, like your
Yeah.
health, and not to mention at some point you're going to burn yourself out, and then also your health is also connected to your brain, and all these things they have to work together. So you have
Right.
to find that balance, whether you want to or not, is always questionable for the person. But you have to find that balance at some point, or you will drive yourself crazy, and it
Yeah.
only affects your trading negatively.
And it affects a lot of other things too. Maybe your addiction,
Yes.
drugs, alcohol. You got family problems. You don't ever respond to your spouse properly, or your kids. You end up getting divorces, and you end up with friends. Issues with friends not hanging out with you because you're no fun to hang out with.
Yes.
And what and then so what, you get down to the end of life and okay, was that much fun?
Yeah.
Did you enjoy the ride, to coin a phrase? uh Not really, you know.
it's crazy. That being to me one of the most important things. And honestly, like I think a lot of people start to realize, like, if they're on all day long and they're looking at it all day long, you're going to do something stupid. You're
Mm,
gonna put on a trade that you shouldn't have put on. You're gonna take off a trade you shouldn't have taken off, and you're gonna do all these things. So you might as well come up with, not to mention how many times, even for myself at this point, if I'm sitting there looking at something all day and it's moving up and down, I will start to feel a little bit of stress still.
yeah,
Even though knowing what I know and everything I know, I know that I will still feel some form of stress. So take yourself out of that position, or
right.
not position, out of the setting, and move
And
on.
that's the self awareness coming in and realizing that you're putting that on yourself and you're increasing the stress. And so then you can get back to discipline and say, okay, well, let's go, I don't know, do some research, or let's go like turn the screen off for a while and just, I don't know, listen to some. I was listening to some Latin jazz here just recently as I was sitting at this morning on my computer. It was
Nice.
wonderful music. It was very mellow. I was in just a nice mellow mood, and I got a lot of desk work done and fairly cleaned off. I've got a few things still, projects here that require my attention in the future, but I can almost see my desk now.
Yeah, look at that. Nice. So one another thing, just to basically before you, I know you're going golfing.
Yeah, it's
So
no problem. I'm in good shape.
okay, cool. So another thing to get to is, what do you think a next step for trend following traders in general? Because I'm noticing a lot of trend followers, and I still haven't done this. A lot of people are starting to incorporate single stocks into their thing, not single stock futures anymore, but single stocks. I've noticed Jerry Parker and a couple people are starting to do that. Do you see any value in that yourself?
Yeah, it's a little bit more than I want to take on just because I don't have the level of automation that I had back at Trendstat days. And although I'm trying to get that in place little by little here, to take me out of doing my half an hour a day of work and get it down to maybe 5 minutes, and then I'll have even more time to go play golf. But I think if you have more automation, I think that's certainly a way to go. I think an easier way is to use ETFs, to use index futures around the world, really. Uh, you can get a lot of exposure to a lot of markets with very different return streams. So that's the one area. I think another area that's very fruitful is time diversification. So if you have like a 21-day based system for a little bit of a longer term futures trading, or even ETF or stock trading a little bit longer term, I would
Yeah.
examine as a trend follower trying to trend follow down into a very small time frame. So get down into the several days, maybe 9 days, 5 days, 7 days, something, so that you're getting into the froth and you're trying to make money when the long term trend following is going to get chopped. You're actually picking up profit after profit, you know, almost from the outside observer, it almost looks like swing trading of some sort.
Yeah.
That type of thing is fruitful. I think the other thing that's fruitful is trying to look at something other than trend following. So selling options premium, selling, doing mean reversion. So you take a stock that's up 4 days straight, 5 days straight, and you short it with a very tight stop. If you get
Mm.
lucky and it turns the other way, and your trend following then is losing back what it already gained, you're actually making money on the mean reversion. That can be fruitful. You can create positive expectancy, but by itself, some of these strategies might not look phenomenal. I mean, if you're selling option spreads, you could, I call it picking up nickels in front of the steamroller.
Yeah.
I mean, because you make a little bit here, a little bit there, a little bit there. You do it for 3 straight years, and then all of a sudden you get flattened
Yeah.
by a long-term capital type of move. I mean, those guys won a Nobel Prize and wiped out their firm. I don't get that. It speaks more to Nobel than to them, but
Yes.
uh, that that's a certain return stream, though. All right,
Yeah.
now if you blended that return stream, which is consistently profitable, and then it gets hit hard with another strategy that was trend following, where the one strategy is getting hit hard, the other one's coining it like crazy. Big bond move means I'm long bonds or short bonds or whatever it is, and I'm slaying it over in the trend following world now to offset what I'm losing over here on the other side. And of course, long-term capital had a lot of leverage built in. If
Oh
you
yeah.
backed off of that, that strategy could still be operational today, and they could have blended it together with other strategies and had
Mm.
a real nice multi-strategy approach. And
Yes.
there's a few CTAs now that are, I mean, I'm chairman of Standpoint Funds, and our Blendex fund, BLNDX is the ticker. It's got something like 75 different futures and a whole bunch of ETFs from around the world. So you got a lot of diversification there and a lot of things going on to provide return streams or losses,
Yes.
in any one day. But it's so much easier to operate that way and keep your track record at least somewhat smooth. To be doing anything like, if you're, to take a ridiculous extreme, if you're a CTA that day trades just the S&P futures,
Yeah.
that's all you do. Well, you're going to live and die with just that one market every single day.
Hey everyone. Tom will be coming back. He had to go do something. I think it was golf actually. So um, Tom went out, had a good day, but he also mentioned, "Hey, I'd like to come back on and finish this out if you're interested." And I absolutely would never say no to that. It's very special to get to talk to him and have this long of a conversation. And he's been so generous with his time and energy to put this much time and energy into this. So, um, once again, check this part out. It's really good. It only gets better as it goes on. So, enjoy. Yeah, and thank you so much for coming back again. Super appreciated you taking the time and
Yeah.
offering to come back. Like I would never say no to that. So thank you very much. And going over the what we already have has been pretty enlightening already. So it's been cool.
So what are our next questions?
So next thing I wanted to get into was I wanted to dig into the COVID crash. So thinking about, you've seen all this stuff in the market, and for me, like I really believe that a lot of the thing in learning how to trade is a lot to do with time, being involved and not blowing up, and kind of having the time to understand and learn strategies and styles and so on. And then on another extreme part of the spectrum, now you've seen so much. You've seen crashes. You've seen a lot of things in the market. Not everything. There's always something new. And then
Always.
then you come into 2020, and were you getting, so for me as a trend follower, you start to get certain signals that sometimes you kind of can see certain things. So I'm wondering what did you see? How did you react? And what happened with your trading during that time?
Well, they started shutting down the economy, which then immediately affected energy big time. And it's just started caving in really fast, but it was already at a somewhat lower point. Having gotten up over 100 in previous years, it was now down in the, I forget, 40s, 30s, or something like that.
Yes.
But it gave me a sell signal. So, being the dutiful systematic trader that I am, I go short, and I held it right through the negative. And I had already rolled out of the negative contract into the next month, so I didn't go negative myself.
Mm,
In the mutual fund that I'm the chairman of, we actually held it right into the negative and made a bunch of money.
nice.
And it teaches you sort of a lesson. 2020 teaches you two things as a trader. First of all, large price movement means the potential for large profit. And secondly, following your strategy, and even though some looks nonsensical, it seems a little bit weird that you're doing this, but just being disciplined and doing it, you figure out afterwards why everything went your way. But I ended up with the best year of my life on my personal account last year. And it was simply because the COVID movements were so dramatic, so fast, that it's exceeded anything I'd ever seen before. So I caught the downswing in the COVID, and then I turned around and energy started going back up again. Things started opening up again. Everything, the stock market started going back up again from being down, and I reversed a lot of positions and made it on the way up. So um, that's the kind of lesson you learn as you get late in the year. It started right around the elections and so on, started just getting a little bit sideways back to normal. But the early down and then the later middle part of the year up was very lucrative.
So your systems are a little bit more, because I run a shorter term system, because I basically learned to build systems from all of you guys,
Mhm.
and I didn't really hear about the newer trend followers and being so long term until later, and I still use the shorter term systems. So do you have any so do you think that it's a combination of using a longer term as a trend follower? Just we'll keep out the other type of systems, but just as trend following systems, do you think it's important to have a longer term and a shorter term trend following
I
system?
I like that concept a lot because I'm finding if you think about the difference of say I have one strategy that's a 9 day and I have another strategy that's a 21 day, for instance, and those two are going to act at any one time in opposite direction to each other and essentially take you into a neutral position. So in a choppy sideways where the long-term one could be getting chopped a bit, the short-term one could actually be trying to exploit the other direction before the long-term one can get out of that direction. And so you can help soften a little bit of the pain of the long term. The long term, on the other hand, is just going to be sort of a steady eddy and on a very long term move. And I've had some moves that have lasted over a year. Back in the day, Japanese yen, I remember, was something like 15, 16 months straight. All I did was roll every 3 months, same position over and over again, move the stops, just rode it the whole way. Very, very lucrative. So you like to have that as I don't know, a core position or ability to pick up these very, very long-term lucrative trades because they pay the freight for an awful lot of losses. However, the shorter term ones can dance a little bit better in the noise zones and kind of offset. And the return streams and the equity curves will be very different between the two. When you add them together, you'll get a smoother line.
Very cool. And then
And I'm not married to 9-day either. You could do a trend following. There's lots of indicators you can come up with to trend follow on a couple days.
yeah,
If you want to do it. You can dig down into the intraday zone and trend follow intraday moves. There's all sorts of different return streams you can pull, and each one of them diversifies the other a little bit.
very cool. And then, so on the trend following systems, do you like to use now? I saw that you have this cool system actually that I noticed it a few years ago where you use Dacian channels, Bollinger Bands, Keltner channels.
Hmm.
What do you think about systems? So everybody usually has some preference, moving averages or breakout systems. Do you think one is better than the other? Do you like one more than another? And what
I like
reasons
to
do you have for that?
I like to think the world of price movement is a bunch of data. And coming from the chemical engineering field, I always liken it back to a temperature control loop on a distillation column or a heat exchanger or something. You've got a lot of outside forces like the weather, the sun being out or not, being at night, that are going to affect the outside of that piece of equipment. And you're trying to hold the chemical reaction to a specific temperature. So you got control loops that'll say you're trying to heat the thing. You'll allow steam to come in to heat the other side of whatever the chemicals that are going through the exchanger. What you don't want to do is to have that valve working constantly. You want to just turn it on when you need to turn it on, and you need to ignore the noise. All right. So isn't that like the market? There's a bunch of noise in the market. So you watch your screen and it's bouncing all over the place. You don't want to try to act on every one of those little tiny herky jerkies. So expand your thinking and say, what would be normal, you know, within here on the bottom side and that on the top side? I don't want to even think about that. That's noise. Above that noise means we're starting to go into an uptrend. Below the noise says we're going to a downtrend. And then you hope it considers, is it going to continue? And in terms of the chemical reaction, again, when you're outside the zone and you get out of the noise, that's when you open the steam valve. And as soon as you bring it back into the set point and you're back into the little bit of noise, then you turn the valve back to whatever steady state is and you try to hold it there. And you hope everything doesn't change, but it will. And when it does, you got to take action. So that's, to me, the mentality I use with trading. The reason I like Keltners, Dunshans, Bollingers, and others, high-low bands, any kind of price channels, is that it gives me a range where inside the range is the noise, outside the range, take action. And it's very specific, and there's no doubt about it. If it's breaking to the upside, you're taking action to a buy. If it's to the downside, you're taking action to the sell. Simple trend following, but it gives it that margin. When you get into moving averages and things like exponentials and that, you don't really have a noise band. You sort of have a signal, but then you have to put an artificial stop based on something else. So now I have to go away from the philosophy that gave me the signal, the moving average crossing over, but then I have to set my stop by like an ATR stop or behind the latest swing low or what, come up with something else. And you can do that. No problems doing that, but it doesn't match my chemical engineering brain quite as nicely as having sort of channels.
Agreed. Very, very much agreed. And yeah, I
And the reason, by the way, I do the three and just take the first one of the three is they all have a noise band and they all have information. If I wait for all three, I'm always going to be the absolutely sluggish at getting in on anything. And it'll prevent some whipsaws, I suppose, but I'd rather be in on the trade and just say that, okay, according to that, if I love all, they're like your children. You love all three indicators equally, but they're all different.
Mhm.
They give you different signals, different timings on things. Sometimes the Donchins win the war, and sometimes Keltner in a big down like the COVID crash. Keltners were screaming down to catch up to the downslide because it happened so quickly. Meanwhile, Donchins are way, way, way up where the highs were,
Yeah.
the month before. That's not very helpful. So Dunchin's going to take a long time to react to that type of action. But in the sideways, where you have a very defined range, the Donchins get very tight, and maybe Bollingers, if it's bouncing back and forth within a range, and Bollingers are seeing the volatility in the standard deviations, then you're going to have wider Bollingers. You're going to have tighter Donchins. Donchins will be your best game in town at that point. So I like the three because like they're kind of like all my children, but they all kind of act differently, and they're based on either standard deviation in the case of Bollinger, the ATR, average true range, which is volatility to an extent in the case of Keltner, and Donchian based on price range itself. So all of them are basing their top and bottom of the range on different math, and I think it's just makes sense to me to maybe use the first of the three. So I usually just take any one of the three that goes over, I take an action.
Nice. That's great explanation. And yeah, I love that setup because it's very to me it was kind of a different and at the same time it really worked very well. So like I'm very glad to hear you explain that. I'm sure everybody will
Yeah.
love that. Um, so the next one was so you're a smart guy. You're going out there. You're doing what you were doing, and you come to start to learn how to trade, and then you end up figuring out trend following. So what drew you to trend following above everything else?
The first thing was that I was busy designing a home, getting an MBA, working as a chemical engineer, and taking courses in landscaping and actually designing a house to move into that I was going to build in a custom fashion. And I was doing all that at the same time, and I had no time. So trend following, especially longer term trend following, seemed to me be an easy way to say above this point, I want to buy it, below that point, I want to sell it, and the rest of it I'm going to ignore. I'm going to update my indicators once a day. It's going to take me however long, half an hour or so to do what I need to do, and another half an hour to transmit orders, get them all checked out, everything's ready to go, and I can put it away for another 24 hours. And that worked with my schedule because there was no way I was going to be able to during the day do anything. So a lot of range trading, day trading, that type of stuff is, especially I'm pretty old. I'm coming up on 69. Back in those days, day trading wasn't going on your phone and doing stuff. We
Yeah.
didn't have cell phones back then. The phones they had looked like a brick, and had some kind of big antenna coming out of it that communicated with a satellite or something. I don't know. And so the the ease of being able to do things that you can do today just wasn't even there. I mean, back when I started in futures, you had to call a broker. The broker had to call the floor had to tell a runner to take a piece of paper out to somebody, or they had to hand signal it into the pits. Then the pit guy had to hand signal with other people and either buy or sell based on the price. Then he had to write up a ticket, and it ended up down on the floor someplace with people crawling around underneath there to get the piece of paper, send it back to the teletype, back to your broker. The broker then could tell you that you got a fill. That might all take a half an hour or more. Nowadays, you just, you go onto your screen and transaction, the confirmation comes back a few seconds later. It's a different world. So trend following just fit me to a glove because fit like a glove because I was pressed for time. That was the early stage. And now even today's world, I don't want to sit here all day and, you know, watch noise. That
Yes.
gets pretty boring after you've done it 30 years. So I'd rather be out golfing or working out or going. did some irrigation work yesterday afternoon. It took me a couple hours. I went out and I was on my hands and knees in the dirt. It was fun, you know. And
Yes.
I even got rained on a little bit, but got the job done. It looks great, and I got to look out at it this morning and admire my work. And it's that job's finished. Cross it off the list. Go find something else to do. But there's
Yep.
a lot more productive things in life to do than sitting watching noise all day long.
No, I agree. And I think that's a thing that happens a lot with new traders is that they get stuck in the noise, and the noise is always very important and a huge problem, and every which way. So that makes a lot of sense.
It's like the action on a slot machine. You know, if you take all the statistics and figure it out, you're going to lose
Yeah.
being on the slot machine because they only pay out X percent of the 100% that they take in, and the casino keeps the difference. But the action of pushing the button or pulling the lever or whatever you're doing seems to be entertaining and addicting to people. So people do it. Um, I can't think of anything more boring than sitting in front of a slot machine hitting buttons, knowing
Yeah.
that I'm going to lose over time. That is to me not something that you need to sign me up for.
Yeah. Oh, that's interesting. And then one thing that was kind of interesting that I found, just every trend follower I've ever met, it's kind of interesting. So if I grew up, one of my first books I ever read was Ayn Rand Atlas Shrugged. And then seeing on your page, and if you go on most of the trend followers are libertarians in some ways. They see,
Hmm. I
so I
definitely am.
so I wonder, just is a theory, because I've just thought about this. This is kind of just random, but why exactly do you think a lot of us who went that route of finding something like libertarianism and Rand
Hmm.
to something like that, and then we all end up finding this style of trading that's also very just figuring out kind of what works. So why do you think that is the case?
I believe that to be a good trader, one of the first things you need to do is take self responsibility. And Ayn Rand talks a lot about the self and why, if everybody in a society first and foremost takes care of self and takes care of the responsibility of being a good self, and then understanding that everybody else out there around you also should be doing the same thing,
Mm,
and that where there's a disagreement, you come to an agreement about what makes most sense between the two selves, but that both selves should be striving to maximize their own utility. When you start taking on self responsibility, self confidence comes in, self awareness comes in, discipline comes in. You need all those traits to be a good trader. So, a lot of good traders are libertarian because they don't doff off their responsibility to the government or to, the Democrat or Republican Party or whatever party you're talking about, or whatever politician is going to save me. Uh, Libertarians would believe, no, we'll save ourselves. We'll take care of it. I don't need you.
yes.
I'm going to figure it out. And that's what a great mentality for a trader. Because if you're blaming the market or the specialists on the floor or your broker for the bad stock tip or that neighbor that told you to buy XYZ at the party last night that didn't work out, I mean, you're not you're not doing good trading. You're just fooling around.
Absolutely. And that's something I talk about a lot, which is you have to have the right mentality to do this well. And if you have the mentality that everything's unfair, life doesn't work out for me, and you're woe is me all the time, you're
Yeah,
going to continue to do terrible at trading because you have to have that self-respect, that confidence, that ability to look just inside and be strong in there, and also
exactly.
to just withstand all you're going to take from trading. There's going to be pain, and learning how to handle that and learning how to do that is something you learn from books like that. So
Yeah, how to overcome challenges, how to get better at whatever you're doing. I mean, I'd say not just trading, that life, what you just said is about life. How can you be going around thinking that the world's a tough place and I got screwed by who I was born as or
mhm.
color of my skin or anything, and and then you're going to try to make a success of yourself, you're always going to have excuses.
Yes.
Yeah, there's no excuse. Just bear down and figure it out, and
Hmm.
figure out what you got to overcome, and overcome it, and beat the challenge, and manage your risk, and exploit your opportunities. And I don't think that, I mean, that in life, that's a good formula, in my opinion, and
Absolutely.
certainly in trading.
Absolutely, and there's a reason why you see a lot of people who are very successful
Hmm.
will have that in their background somewhere,
Yeah.
and that's really important, incredibly important, because we all really need to understand that you have to have that ability to constantly look inside yourself and know that you can overcome anything and get through it. Especially with trading, your first years of trading, like you said, you have this great trade and you give some back and you have these painful times and you learn and you learn and learn, and at a certain point you get to build to where you had Trendstat and now where you're trading today, and
Right.
that takes time and effort, and that wasn't as you are Mr. Serenity, and you you do seem very, very happy. There are also times where you've had to really buckle down and say, okay,
Hmm.
well, this is going to be just a hard day. This is going to be
Hmm.
hard, but I'm going to get through it, because you have that confidence in yourself, and
Yep,
that's really important.
that's correct.
Very cool. So we'd like to end all of these with one question. If you could tell yourself a couple years into trading some things that you know today, what would they be?
Well, the I would approach it the opposite way that everybody does, including me. Is I started out with the typical buy sell engine. So I was looking at point and figure charts and moving averages and all the indicators, and then back in the day, I had very, very small accounts. So of course, one contract of corn and one contract of maybe hogs or something, and that was my entire portfolio probably. And then after the silver trade, after a lot of other examples, reading Larry Height's chapter in Market Wizards, I developed ways of position sizing. So now it was no longer, fortunately, I did have more money to be able to handle, so I could do some position sizing and have a position that might be three and go to two and go to one, and move it around a little bit depending on the risk levels and the volatility levels. So that was the second major part of trading, was buy sell engines, and then sort of position sizing. And then along the way, you end up realizing that the third area, and it's far more important than the first two, is the mental side, the ability to have the discipline, the self awareness, the self responsibility, all those good things, to know yourself, know what you have to do to get the job done every day, and to be disciplined, to wake up and to be, alert and not hungover and not out of shape and not, you know, terrible diet and having family problems and everything else that goes on in life. If you're going to let all that get in the way of good trading is going to be hard to pull off, because there's going to be a lot of different things, your own health, your own mental health, your own family situation, and everything that's going to come and try to intrude on your normal trading day. So I would have told myself to reverse that if there was a way to do that, to really become aware of the mental side of trading first, and to try to understand more about what I was trying to create before I tried to create it. So if you try to create it and you try about 50 different things, and most traders do, and they finally settle in on, oh, I think this works pretty well, I feel comfortable with this. Well, how about if you went back and said, why don't I take my situation? How much time can I spend each day? How many assets do I have? What markets do I know or want to trade? What what kind of diversification do I want? What kind of risk per position would I like to take on? All of these different questions, almost take an inventory of yourself and your situation, your skill levels. Do you know computers? Do you not know computers? Do you know math? Are you terrible at math? Who do you know that trades and that you can use as a resource? What places, like Steve Burns' site with all his trading education, Enjoytheride.world, my site, all these the books out there. I've got a whole recommended reading section of the site that just goes into all sorts of books that I've already, think have been useful to me. If you can prepare on all of that first, before you even try to worry about whether you're going to use a moving average or a Keltner, you'd be way ahead of the game. And you also then can back yourself from how much you're going to take on in risk and where your assets are. And can you shift more assets to your trading account? Because in some ways, a larger trading account is a lot easier than trying to deal with a little tiny small thing, because especially like in futures, it's getting to be with the volatility we see in these markets, you need $1 million to trade a futures account practically.
Yeah.
I mean, you can do it less legally, but to do it professionally and keep your risk in control, keep your diversification up and everything else. I ran studies back in the Trendstat days. We probably had about a 25 contract portfolio, and we were running million minimum to get what I would call a lack of granularity in the statistics. So the difference between 1 million and 1.5 was not huge. The difference between a $500,000 to $1 million was huge. The difference between those two size of accounts, no question in my mind, the return to risk on the million is going to be better than the $500,000. So we refused less than that because it was just not doing a good service to the client. And a lot of people would say, well, I only have this much, would you do that? I said, no, because here's the study.
Yes.
You're hurting yourself. Well, I don't want to do that for you. And it's not that I'm being obnoxious or think more highly of myself than I should or anything like that. It's just the math says that you need this much to do the job right. So let's do the job right. And so I think reversing that process to the younger self would have been maybe a little more useful in avoiding some of the pitfalls that I ended up in by just being completely over leveraged and under diversified and not understanding myself very well. And in the early stages, being very over caffeinated. I'd go through a pot or two of coffee a day when I was in my 20s. And I finally figured out, thank goodness, that it was not helping the cause. And when I got rid of caffeine at that level, I mean, if you have one cup of coffee is probably not going to do that much to most people, but and I'm 6'3" and over 200 pounds, so one cup of coffee is going to spread over a lot of body for me. But when you start knocking down a couple canisters of that stuff, now you are you're going so fast, your mind is so alert and is trying to race so much that it starts eliminating alternatives that you might think of if you were calm and collected, if you were Mr. Serenity.
Mm-hmm.
So if you take the picture of a Mr. Serenity and say something's happening in the market, a Mr. Serenity, because he's just calm and collected, can go off and think of something else and say, well, yeah, that might be the case, but how about this instead? If you're very caffeinated, you just react, you go. Everything's fast. You don't think of alternatives. You don't bring yourself back to a balance. You get emotionally pushed because you're reacting so quick. So I found that boy, getting calm and laying off large amounts of caffeine was very helpful. Now that being said, this is a caffeinated iced tea. So I'm having this much today, and the markets are all over. So I'm done.
That's good to end the day with,
Well, I'm going to head out to I'm going to do some water aerobics after this, and then I'm going to go out and try to play 9 holes. So having a little bit of energy along those lines for water aerobics is fine for me. I'm not going to be thinking of very many things. I'm just going to be trying to push water.
Nice. Do you have time for one more?
Yeah, I got
Okay.
time.
I just thought of this, and actually, it's funny. I have this list. It's actually sitting right next to me, which is questions. But this is the first time in an interview that it's just flowing so smoothly. We've just continued to talk and knock out most of them, which is really cool. But so diversification.
Mm-hmm.
So you just brought that up a little bit, which is why it reminded me I did have a question I wanted to ask you about that. So speaking on diversification, and we'll use the $1 million account size.
Okay.
So with $1 million, how many markets would you say would be normal to trade? How many different? Well, we'll just say how many different tickers, not markets.
Yeah, for $1 million, for every million, starting with 1 million, I would say I'd be shooting for the 40 to 50 range on different tickers. And more importantly than that, I would probably put about 20 of them or so in the futures area and
Mhm.
another 20 or 30 in the probably ETF area at that level. I probably wouldn't mess with individual stocks until I got up into the multiple millions. It's just too much of a hassle. I'd rather just, and you got to understand, I'm in retirement, so I want to keep things easy. If you were really trying to go for it, sure, dig down to XYZ, the stock that's going to double next 6 months. That's a lot of help to the portfolio if you can figure that out. But I'm happy to buy a technology ETF instead of going trying to buy a Twitter or something. It's just a lot easier for me. I don't have to worry about corporate risk as much. I can do it all automated. Liquidity is good. I get the diversification I require. And by doing sort of what I would call a stock overlay, by keeping, say, 75, 80, 90% of the equity in the account into the equity side, and then using the other, say, 15% or so for futures equity, I essentially am trading sort of $2 million on $1 million, but I'm doing it across 25, 30 markets.
It
So
makes
I'm
sense.
getting lots and lots of good diversification there. If you look at the stock markets of the world, and I did this during the COVID crash, almost every single world stock market where there's an exchange that you could trade went down during the COVID crash. It was just a question of how much. So you could buy and hold all you want, and you can buy and hold the entire world. And the only question is how much are you going to lose? Not trying to protect yourself, and certainly not trying to exploit opportunity, which I did during the
Yeah.
COVID crash. And I think that by getting into some of these other areas and doing it carefully and with caution and with protections and with risk control and volatility control and all the good things that you'd like to have, I think you can safely go after different return streams and do a better job of diversifying yourself than just, buying a portfolio of 10 stocks.
Agreed. And that's the one thing that even I am not in retirement, and I still really believe, going through and picking out individual stocks just isn't my strength. And I know that how to make consistent returns this way makes the most sense to me. Of course, there's going to be people who do one or the other. But for
Sure.
me, I'm still on that same boat where I see exactly what you see, and my back tests say the same thing. In an actual drawdown, you will get hit wherever you are at. There is no escaping it, especially if you're in a liquidity event or
Mm-hmm.
something. There's really no escaping it anywhere. But if you have a diversified trend system, you will be flipped at that time. So you'll be short a lot of things. You will be long things like bonds because they will give you signals and so on. So you will
Yeah.
make money while everybody else is having that drawdown.
On my ETF portfolio, I was losing money during the COVID crash,
Mm-hmm.
clearly. Because I was long ETFs, and until I got stopped out, my hedges kicked in. I made a bunch of money on my hedge, which was great. Lost some money on my ETFs. That's fine. That's part of the game. And I would expect to, in a down market, down 35, 33, whatever it was on the S&P, I would expect those ETFs to lose money. So I'm not going to change my strategy because it's doing exactly what I expected it to do. Lose money during a down market. That's what it's supposed to do.
Yes.
If it didn't, I'd be looking at it saying, what the heck's going on here? That doesn't make any sense. And then you go over to my futures trading. Crude oil's plummeting because the economy is being shut down. Nobody's going to go to work anymore.
Mm-hmm.
We're going to work from Zoom land. So all of a sudden, crude oil goes negative. Well, it's a downtrend. You short it, you make money.
Yes.
So there's a movement that is exploitable that you can end up making a positive return stream.
Mm-hmm.
In the end, what do you got to do? You got to add all these return streams together and figure out whether your portfolio did okay. And
Yes.
mine did okay.
And that's
So
the one thing that's interesting about the COVID crash and trend trading in general is that you see this kind of flow in the markets where, like you said, oil and energy started to move down. You had the banks starting to move down. You had all of these things kind of moving a certain direction, then everything follows it. Then certain things kind of picked up. You get these signals and you just continue to take the signals. And if you can backtest over time, you will make money, but you have
Yeah.
to continue to take the signals and all signals.
Yeah. Yeah. It's so tempting to say, and a lot of CTAs did this in 2020, and to their detriment, they just said, this is nuts. I mean, the whole world's going crazy. If you bought the Kool-Aid that the pandemic was really as
Yeah,
threatening as they seem to be wanting to make it, I think it was very overblown in the end, looking at the data myself. But
me too.
I let each person form their own opinion. I have mine, and I think this was a bad flu in my mind. And,
Hmm.
you know, if you're in good shape, especially if you're young like you
Hmm.
and in healthy and all that, your risk of death would be so minimal that it wouldn't be worth giving it a second thought almost. If you were your grandmother
Hmm.
and rheumatoid arthritis and on oxygen and everything else, very, very threatening. So it depended on the individual. And I think that's the key that was missed during the early stages of the thing. And so you got interest rates plummeting. So bonds are climbing. So you go long bond futures, you make money there. You might have, that maybe we're going to have deflation. So the precious metals are getting killed or whatever. I can't even remember what was happening then. But then you all of a sudden have like copper, which is used in a lot of industrial stuff, which is now closed down because nobody's going to work,
Yeah.
falling apart. So you go short copper, you go maybe short platinum, gold, silver,
Mm.
natural gas, and crude oil, maybe
All of the signals.
I mean, there's just
Hmm.
lots of different things that could happen. And if
Hmm.
you have a potential to exploit those,
Hmm.
you can diversify yourself. If you just trading a portfolio of 10 individual tech stocks and tech stocks are all plummeting at the same time, good luck.
Yes.
You're going to have a drawdown. You can buy and hold and just wait, pray that it comes back. But if you go down 50%, you got to make 100% the other way to get back to break even. That's a tough game to play.
And that's why it's interesting that we focus on trend trading because it exploits those things. Like the panic was, like you said, and I agree, it's an overreaction. That
Mhm.
was an overreaction to the pandemic, but our trading style, we make returns on overreactions. We
Mhm.
do well when we have those up or down, whatever the market environment is. We can usually do pretty well on, especially panics.
Right.
Panics are very, very profitable for people like us.
Yeah, they are. And the opposite's true. If we're in a stable environment and nothing's happening,
Hmm.
if you got to buy low, sell high to make a profit, or sell high, buy low.
Hmm.
But if the price stays the same, there's no buying low, selling high because it's not moving. So there's no profits to be had, and chances are you're going to get whipsawed along the way.
Yes.
So that's the opposite is true during stable periods. So
Hmm.
we love the black swan events, and we love the when things are moving and panic setting in or over enthusiasm is setting in, which has been happening lately. Those are
Yes.
the times when a lot of money can be made. You just have to kind of go with it and realize that you've got a strategy for getting out of it and reversing the other direction or just liquidating it altogether or whatever. And have the strategy in place in the first place.
Hmm.
Don't don't try to make it up on the fly. It's a tough game to play.
Yes, and you brought up and I had a bunch of CTAs and friends that were doing the same thing where they just stopped trading. They just didn't know
Yeah,
what to do at that point. They just said volatility is too high, and and it was you couldn't have a conversation with them about, hey, maybe take your position sizing down, whatever you want to do. But
there you go.
if you want to stop trading, that's almost insane. It's there's always going to be these panics, there's always going to be these problems, so the whole point is to continue to do these things. The system really letting itself go one day, I think anything is possible, but we'll have something bigger to worry about than we didn't put on our trade. I'm
But
pretty
then if you
sure.
analyzed all those CTAs and you asked, do they have position sizing? They probably do in some
Mhm,
fashion. It could be better or worse, but they probably have something. Do they know how to do a buy sell indicator? Sure.
mhm.
So what caused them to miss out on all those profits? It was the mental side.
Yes.
And so that's why my younger self, I tell them work on the mental side first,
Hmm.
because the mental side can always override the other two. And then you can have the best buy sell engine and the best position sizing in the world, and it won't make any difference because you'll shut it down.
Yes, absolutely. And that's so the mental side is so important because that's the thing that they couldn't envision. A lot of people couldn't envision the market coming back the way it did, going down the way it did, because everybody gets too excited as it's going up. Nothing changes sentiment like price. It's moving up. Everybody loves it. It's the best thing in the
How
world.
many
It's
how
going to go up
many wanted
forever.
to see the test of the bottom? I'm
Yeah.
This will go up. I'm going to wait for a test.
Yeah.
And they watched it go all the way to the sky with no test.
Yes. That's
I'm
another thing to
I'm
bring up. Go ahead.
I'm fond of saying the market will do whatever the market will do. Don't try to guess. It can do
Agreed.
anything it wants to.
And that's a good point. I was going to ask you about. I know a lot of, especially newer traders. Everybody likes to think of profit targets. Oh, I'm going to buy this. It's going up. Here's my profit target. I'm going to get out right here. For us, it's almost laughable because, like you just said, markets will do whatever they want to
Whatever they
do.
want to do.
They will blow past your profit target sometimes. And once in a while, sure, you're going to hit it. You're going to be smarter than I am, but most of the time it's not going to matter. It's going to continue, and it's going to go a lot further than we ever dreamed, either way, up or down.
Or not even make your profit target on the other
Yep.
side. The market will do whatever the market will do. Just quit trying to outsmart it. Just let it do what it wants to do and react. That's all you got to do to be a good trader. You don't have to. It really is not as cerebral as you would think. To me, a lot of my trading world, if you wanted to, with my math background, computer background, and brain, if you want to credit me with intelligence, I would say it was applying the math and computers and intelligence to trying to simplify reading a lot of price data and making sense out of it, and separating it from noise into information. That's basically all I've been doing all my life.
Yes. And
It's not, I don't understand the mathematics and putting a guy on the moon and, elliptical orbits. I've never got into that kind of math, but that strikes me as very difficult math.
yeah.
What we're doing in the markets is it's add, subtract, multiply, divide mostly, maybe a
Yes.
percentage every now and again, but not that hard.
And that's another thing. You tested it, and I myself have had clients say things to me like, why didn't you get out there? Why didn't you get out there? And you're like, and I know like what I say the same thing to him all the time, which is, well, if I back tested and that worked best, I would be doing that. It just doesn't. And I'm sure you've back tested that, and it just doesn't work as well as really letting it run, being willing to give some back if you have to. It's going to
Mm-hmm.
happen. It's going to
Yep.
happen millions of times. But
Right.
those winners being so outsized, they really pay for the losers.
That's right. If you don't have them, the losers can swamp you.
All
I
right.
remember 1 year, two trades were the difference between breaking even and producing a single digit profit for the year at Trendstat. Two
Oh, really?
trades. Yep. Those
What
two
trades were
trades were
those out
huge.
of curiosity?
Well, one of them was a Japanese yen trade, and the other one I think was like a bond trade or something. And they were huge moves. I think it was back in the days when interest rates were coming down off their record highs, and the Japanese yen ended up getting cut in half in price or something. It was amazing. Both trades were a year or longer in duration, and they made so much money that they were the difference. And we took everything else, added up the gains, added up the losses. There was less gains than losses in numbers, but the gains were bigger than the losses because cut your losses short, let your gains run. But when you added all those up, you were about at zero. And it took two trades and the profits from those trades to add, I think it was like 8% per year or something. We ended up that year, but it was a positive year for trading. It just wasn't a,
Yeah.
you know, a banner. It wasn't brag about your year time. It was just thankful to get through the year and produce a profit.
And
But
up is always good,
up is
up.
better than down.
But
So
that what you just said, there's I hope everybody takes that, because there's a lot of wisdom in what you just said about the two winners being the difference in your year, and
yeah,
that's very usual. That's how it works most of the time. I think last year was the first time I ever had a lot of different winners.
yeah,
We've had good years, but we've never had so many different winners because of the way the trends went last year,
yeah.
and that's
Same
it.
same with me. I had a long number of winners. Yeah,
Yeah,
there was a lot of winners last year because of the movements. Things like lumber crashing and then going up in the economic boom thing, and then it tops out and starts going limit down every day. There's money to be made on the upside, and there's money to be made on the downside. So you just you don't sit there and try to outguess it. You just go with it, and it's kind of a weird philosophy for a lot of people to embrace. But in when you step back and think about it, how easy can that be? I
yes.
mean, you just let it do its thing and go with the direction and don't worry about it. A year from now, you'll be able to look back and tell the story about why you were successful in that trade. But at the moment you're doing it, you have no clue that this is
Yes.
going to be your biggest winner of the year is happening right now. And you have no idea that it's going to be the biggest winner that you are going to own.
Well, it's the same reason why you were able to have such a good year last year, to
Mhm.
the up and downside, and really being able to think outside, because the market will always move before the economy does. So
Yep.
we're not sitting here trying to predict that, oh, this pandemic will do this pandemic will do that. Price action says it. Most of the time, the price action will lead what actually happens in the economy, and we're in the trade based on the price action.
Hmm. Yeah. And a lot of traders were sitting there either watching CNN or Fox News, depending on what side of the political aisle you're on. And I'm
Mhm.
going and getting the CDC data and putting it on my spreadsheets and analyzing it myself.
Yes.
And so I'm getting my own sort of a little bias because CDC, I think some of their data, I'm not so sure how they collected that and how tight the data is. But even
Same.
given their data, I figured out that I've probably got a 99 point something percent chance of survival in this thing. And
Yeah.
I'm sitting there thinking we're closing down a multi-trillion-dollar economy for something that has a 99% survival rate. What the heck is this all about? It doesn't make any sense to me. So I
Yes.
just I just kept trading, ignored all the news, and just kept doing my thing. And
Exactly. Look, you've done. That's another thing about you, and being able to do this for so long and observing yourself while doing it, is that
mhm,
you, even though all this is happening around you, you still reverted to that. I'm going to take the signals, take all signals, do exactly that, and everything will be just fine. And you have this great year because of it.
yeah, and I'm going to take responsibility for my own health, and I'm going to stay in shape, and I'm going to eat well, and I'm going to isolate in the early stages because that seemed appropriate at the time. But as you find out more and you get more statistics and data coming in, you just shake your head and this is everybody's panicked. They're overly panicked. This is really stupid.
Yes.
And then it goes the other way. And everybody's into the euphoria lately. Right now, I get a little nervous that everybody's a little bit too excited about the prospects for the economy and everything. I'm seeing a lot of different things that, as I dig into, the interest rate charts and
Oh yeah.
the amount of money expansion, inflationary pressures on things in commodities. I trade commodities, so I see some of that. There's just enough worrisome things going on. My wife's an expert in real estate, and we just sold out 3 of our rental properties and liquidated our rental portfolio completely,
Smart.
just
Very
in the
smart.
last 6 months. And we got more than the appraised values on all of them. And I think I look at what's going on in the real estate business, how many different houses up here in the mountains where we're in this golf community that we're at, that are under construction right now. It's just insane. I wonder if these people aren't going to regret starting some of these house projects that are, multi-million dollar house projects,
Oh yeah.
a year or two from now or whatever. There's a lot of things that I'd be a little nervous about stretching your finances out too much, right? Along these days here while we're talking,
No, I
uh,
agree.
but
It's very crazy.
that comes back to this. If you're caffeinated and you're emotionally reacting and you're, whatever, listen to the television and what they're preaching or whatever, and you don't do your own homework and you don't sit back and use some common sense and use some ability to look at data and try to come to your own conclusion about what's really going on, then all of a sudden now you can, from a place of kind of quiet and serenity, react to it all and say, that's just noise out there and that's noise out there, and I'm just going to do this. And that's kind of where I've been at for a long time, and maybe why Jack Schwager thought of me as Mr. Serenity, because I was so sort of peaceful in how I go about, the job of trading. And most traders don't do that.
No, I don't think
If it
so.
works for them and they're successful, okay, go for it. But I don't know. Some of the traders that I've seen over my lifetime literally shorten their lives, being stressed out all the time, and they have shorter careers. They get burnt out. They get alcoholism. They get drugs. Uh,
A lot of blowups. There's a lot of
it's,
blowups in the business. That
yeah, a
a lot of
ton.
ones that people don't hear about.
Yeah, they don't make market wizards.
No.
Although some of the market wizards have blown up.
Yes.
They were pushing the envelope so much they no longer are around.
And that's the one thing that I think was is very interesting, because we could all talk about who has the biggest returns and who does this, but stability and consistency is also it's underrated in trading, and that's the one thing that people don't think of. Yes, you could have 100% year and then a negative 50% year and then 100% year. People don't think of what a consistent 20% looks like in 30 years.
Even better yet, break it down into monthly if you want to talk about consistency, or weekly. Mark Minervini is always pounding on everybody, compounding. It's so important.
Mm-hmm.
And he's right, because if you can just keep producing a profit, is say in a minimal sense, just a small fraction of a percent per day. But if you could magically somehow do that every day, by the time you get to the end of the year and you compounded that little tiny percent all the way out every trading day for the entire rest of the year, you had a phenomenal return. You didn't need to make a lot of money each day. You just needed to be consistent. That way you don't have to come out of those drawdowns and have to, like, if you're down 50%, you got to make 100% to get back to break even. If you're down 10%, you only need to make 11.
Yeah.
So squeezing down the drawdowns, diversifying by markets, diversifying, by strategies, by time periods, anything you can do to help yourself there. All you're doing is squeezing down that the noise in your equity curve.
Yes.
And if you can compound a very tame rate, you don't need to be shooting for 100%. You just need to be plodding along, grinding it out, and not going down. If you can
Yes.
do that, you'll be fine.
And a lot of people, they look at this as something that they have to hit these home runs, and they're gonna, once they get here, they'll be able to do this and all this stuff, but and that's just not the way to look at it. The way to look at it is exactly how you just said it, and once again, just as I know, sitting there and trying to make sure your returns go up every single day, you'll drive yourself crazy. But figuring out
Well,
how to do
it's quite the brain tease, I'll have to admit.
yeah.
I haven't figured that out yet. I
Yeah.
have to admit.
But figuring out how to be consistent on a quarterly, monthly, even yearly time frame is a great way to do it. And either way, even if you're having that monthly, I'm not going to kill myself in a month. Making sure Paul Tudor Jones had a thing. I think he shut his fund down basically if they went under. I think it was I'm guessing, but I think it was 10-15% in a month. he'd shut his fund down because he never wanted to go under that. Because, like you said, you need 10%, you have to make 11%. So it's really important what you just said.
Well, and he's also a discretionary trader. So if it's him that's driving it and
Mm-hmm.
he's not feeling it, then maybe he needs to just take a week off and recharge and come fresh at it. That might
Yes.
have been more of that. In my case, I never wanted to do that because I never know when that next good trade's coming over. So it might be the week that I'm taking a break. And so I never took breaks. We traded right straight through Christmas and everything. I mean, Thanksgiving, 4th of July, we had staff on hand, because you guess what? Britain doesn't recognize the 4th of July.
Yep.
We were revolting against them. So they're still working over there. The markets are open. If you're trading British pounds, you better have somebody in the office. Even though it's our holiday, it's not theirs. So when you're trading world markets, you have to do stuff like that. And that's just part of the business. But I always felt like I had to make sure we were there for every trade.
I like the
And
way
we,
you put that about tutor, because I'm always harping on people about the take all signals at all times. But you're right. If you're discretionary, that's makes perfect sense. Well said.
yeah,
Yeah.
because he's driving through his sense of the markets, perhaps. And I'm not against discretionary trading. If you want to be a
Same.
discretionary trader, I think there's challenges with it and you have to address those, but it's really, really focused on the mental side. If you're a really super mental guy and you're really, really weak with uh, computers, math, that type of thing, maybe more discretionary trading is for you if you can rein yourself in from getting emotional and all out of whack. I submit a lot of people that start out are going to have a hard time doing that. So Paul Tudor Jones was one that seemed to find his own little flow there, and he exploited it for billions. So good for him.
Very well said.
I'm there's a million different ways to trade. I don't think everybody, the way I trade is custom designed for me and my situation and my net worth and my computer expertise, my math expertise, everything that I know and is me. That's how I designed all this stuff. This is not designed for the guy that lives across the street. He's got a different situation. He's got to come to a different answer to his financial puzzle. I've come to an answer for my financial puzzle. That's the way I look at it. Everybody's got their own puzzle they need to solve. Don't Nobody should be out there trying to just copy me. That's kind of dumb. You're not me. Why would you do that?
And you'll never stick with somebody else's strategy like that.
Nope.
Everybody thinks they can find a guru, and that's kind of why I started my group in general, because everybody thinks they can find a guru. This guy's going to write this. I'm going to follow it and make and it just doesn't work that way.
Nope.
You're never going to have the same drive that person has to hold on to his positions or whatever. You have to really do the work yourself.
Exactly. Exactly. Yep.
Well,
So
cool, Tom. Will you hang out for a second after this so I could say
sure.
okay. All right, guys. Thanks so much, Tom, for coming out. I mean, letting us talk to you twice. That was just we're so grateful for your time. It was a blast getting to listen to you talk. So I'm sure I'm going to
Yeah,
listen to this
and
interview a bunch of times.
you asked some excellent questions, and I enjoyed the conversation.
All right. Thank you.